This is why for CMHC to say, hey, we're not going to have a severe enough recession like we did in the 90s, I would point them at this graph and say, you may not be using the proper data points, or you're just being a little bit too rosy about where the economy is right now. Which leads me to the next thing that they discuss, which is supply. And I have been saying for a very long time, supply is the biggest indicator of where things are going to be in the next 30 to 60 days. And now CMHC is arguing that it was more speculative in the 90s than in what it was in the 2021s and 2020s and 2022s of the condo market. And I would say that I don't agree with that necessarily. Toronto condo prices have crashed 25% since the peak of 2022. And while CMHC says a recovery is just around the corner, I'm here to show you why I think that prediction is flawed. The warning signs today look eerily similar to that of the 1990s downturn, and the data reveals patterns that most people are missing. So stick around, because once you see what's really happening from the data I dug up, you'll realize this crash may just be getting started. Hi, my name is Zen. If you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. So is Toronto condo market downturn a repeat of the 1990s? And CMHC basically argues that it is not because of different macroeconomic factors on top of supply and immigration and interest rates, which I'm going to break down for you right now. But the most interesting thing that I want to point out to you right away is we're going to talk about the prices. So this is the chart that CMHC has, and what you're seeing right now, so you understand what the chart is talking about, is over here, 100 represents the peak of the market. And on the x-axis, it means every single quarter afterwards. So the blue line is basically what happened in the 90s. You can see the pricing peak in 1989, first quarter, and it went all the way down, trickle down to 1999. And then it still didn't reach to the 100% of the peak when adjusted for inflation. And you can see over here, we didn't really reach back to the 100% after 1999. So it was a pretty rough time for a lot of condo owners. Now, when we look at the red line, this is what has happened so far in the quote unquote condo crash. So starting in Q1 of 2022, for reference, the 4 and 6 condos peaked in March, and I'll show you what that price was a little bit later. So that would be 100. And we've kind of come down a really sharp decline relative to the 90s. We matched them in, say, 2024, because that would have been about 8 quarters. And now we come down a little bit more. And based on CMHC's forecast, and you can see over here, we are going to be going up in this direction. Now, when this is, I'm not sure. But what they're basically arguing here is that by 2024, Q4, prices, when adjusted for inflation, will be 83% of the peak pricing over here. So this is all dandy and stuff, but let me just show you what this actually means on a number basis in Toronto condo pricing. So I recreated CMHC's forecast right here for you. And you can see I am going by every single quarter, and they are ending at 83.2% of the 100% price. Now, I don't know what their numbers are. It was rather linear on the chart, so I just put this as a linear format. It's going up based on my calculations of 0.8% appreciation per quarter, which is 2.4% annualized per year, which by my metrics still seems kind of high, if you ask me, for end of 2025, because I've been saying baseline maybe at best 0 this year, and maybe 1 or 2 next year, and then maybe 1 or 2 afterwards. They have this thing baked in at 6 to 7% at the end of 2027 in total. So a little bit more aggressive than my stance, but here's kind of what the numbers on an actual amount will look like. Because in March of 2022, the condos in 416, so this is inclusive of 1-bedroom studios, 1+1s, and 2-bedrooms, so average was $831,000. Currently, as it stands, based on the latest stats right now for August, would be $618,000. So we are down about 25.6% from the peak. So using CMHC's forecast, as of next quarter, they start their appreciation. Things have quote unquote bottom out, which I do not agree with. But when we go up slowly, and we get to say Q4 2024, so in 2 and a bit years, we're going to reach 83% of the peak price, and 83% of the peak price of 830 puts us at $692,000 when inflation adjusted. Do keep in mind, inflation is not 8% right now. It's like 2-3%, give or take. So it's not that high, which basically means that even with CMHC's bullish, from my perspective, kind of price forecast of where things are, we're still going to be down 17% from the peak. So I wouldn't say this is a great looking forecast. There's a probability that it could happen. And so much of it really depends on how the economy looks like. Because if you have no jobs and no job growth and we're going to recession, I highly doubt this type of forecast is likely to happen. It'll probably be worse off than what CMHC has. Now, if we miraculously do not have a recession, maybe things will get a little bit better. Hey, it's me interrupting myself. Ready to make a move? Just one free call. No hassle, but decades of experience to work for you. Because one of the data points in this CMHC report is saying that the condo downturn in the 90s unfolded during a severe recession. Yes, we're not in a severe recession right now. Looking forward, according to StatsCan, we're going to get a mild recession where it has modest impacts on the housing market. And again, that's TBD. But the biggest indicator I've been saying for the past few months has been, what is the unemployment rate looking like? Because if there's no jobs, and people cannot service their mortgage, we're going to have a lot of people who need to sell, which means supply is going to increase, which means prices are going to come down, even if interest rates are going to come down. And that is the biggest crux, the unemployment rate. So if I were to compare the 1990s to current right now, you can see I could only get data for Ontario unemployment rate. And in Ontario in the 90s, we peaked at about 11%. I can see that over here. And we kind of hovered around 9% up until like 1996. But you know what's the interesting thing I'll show you? When you hit a really bad recession, things go parabolic in how fast the unemployment rate increases. Where are we right now? At the end of the 2024 data I could get, Ontario ended around 7% right here. I can tell you the latest print in July for Toronto is 9.2%, which puts us squarely right here. Do you think we're gonna go parabolic in the unemployment rate? Are we gonna increase past 10%? My money's on yes. And this is why I think that when we're looking at the unemployment rate, I think a lot of the government is discounting how bad the economy is right now. This is why for CMHC to say, hey, we're not gonna have a severe enough recession like we did in the 90s, I would point them at this graph and say, you may not be using the proper data points, or you're just being a little bit too rosy about where the economy is right now. Which leads me to the next thing that they discuss, which is supply. And I have been saying for a very long time, supply is the biggest indicator of where things are going to be in the next 30 to 60 days. And now CMHC is arguing that it was more speculative in the 90s than in what it was in the 2021s and 2020s and 2022s of the condo market. And I would say that I don't agree with that necessarily. Because their argument right now is that, yes, a builder has to sell more than 70% of these units before construction can begin, and it wasn't the case back then, and that's all correct. Yes, that's perfectly fine. But there are still fringe cases that I have heard and other people called me about where they took one mortgage letter to buy multiple pre-construction units, hoping to flip them all before they all had to close. Now, I don't think that's going to make up a large portion of the condo buyers in a particular project, but it still makes up a small percentage of them. And the percentage of people who aren't closing is probably going to get larger and larger for the next 2 years because that price gap is getting bigger and bigger. So to say that it wasn't speculative in the pandemic era, I would say is false, because it was still rather speculative. Because some of these pre-construction condos were bought at 40% premium on the resale. So it's not about can you service the debt on that, it's more so can you even get a mortgage for the value that you paid for it, because a lot of these contracts are like 30-40% underwater right now. Meaning without one particular bank giving a blanket appraisal, then we're gonna have an appraisal problem and people may have to chip in a few $100,000 just to close. And if they don't have that few $100,000 in the economy that we're in right now, which isn't great, then they're not gonna be able to close, they're probably gonna get sued. And that's a ripple effect for the entire market. That's what I'm more concerned about, not so much this debt servicing thing. Now, in the report, they also argue that the increase in condominium prices was driven by limited supply. Yes, that's true, but a lot of people don't talk about the demand. And if the demand was from low interest rates and immigration being very high, well, interest rates are, call it, within the 10-year norms right now, and immigration is slowing down. Which is why I completely disagree with this idea that there is a limited number of supply in the next 4 to 5 years. I think we have way too much supply when investors back out, and a lot of people end up going to the rental market, and only really just the first-time home buyers are buying right now. The numbers just don't make any sense. Before you even think about selling, don't let another chatbot price your biggest asset. Your property is not just another number. Hit the link in the description below and I'll send you a personalized assessment with real data and expert insights so you can sell with confidence on your terms. And here's kind of the saving grace for if CMHC actually has their forecast correct, which is talking about what interest rates look like relative to the inflation. So if 0 is over here, it means that anything below 0, when you are taking a mortgage because you have an interest rate against the mortgage, if the inflation rate is higher than that mortgage, it basically means that your dollar is being devalued faster than the cost for you to borrow that money, which is basically them giving you money. So we have seen that before, and this is what we call negative real rates, which is this chart over here. And let me explain how to read this chart. So in the areas that you have all red, it means that negative real rates, or when the cost to borrow is lower than inflation, it means that asset prices generally go up. So you can see this from 2010 over here, all the way up into when interest rates kind of skyrocketed, we had negative real interest rates. And all that basically means is that asset prices go up. Now, when you look at the 1990s, as far as this chart can go back, the prices went down because we had positive real rates, which basically meant that why would you take on risk to buy an asset when you can just throw this thing into like a GIC and get 5 or 10% interest rate because the real rates were positive. And what we saw in the last few years where real estate prices have been coming down is basically this little chunk here that's been green. And that's when prices came down because real rates were positive. But because we are doing another rate cutting cycle again, and let's say the blue line that marks inflation is still flat, we could be in this little cycle here where negative real rates are happening again, which gives an argument that asset prices can be going up in the future. So when interest rates are falling, where they will make an impact is when they get negative. And even though in the last little bit when interest rates were falling and it didn't move the needle, it's because real interest rates were still positive. Now we are getting to that point where it crosses. And when interest rates keep falling at this point, some of these investments will start making sense again. And let me just give you the example of the last two projects I talked about. So this condo where there was 30 units that dropped from $1,100 a square foot all the way down to $675, when I ran the numbers, they were basically cash flow positive a few $100 at the current interest rates. If interest rates drop a little bit even more, they're cash flow positive $200 a month, which isn't great for the risk you take on. But it makes sense if you're betting on the fact that we're going to see some kind of appreciation on the value of the asset, or we're going to have so much money pushed into the market because we're in another negative real rate environment again. And this 3-bedroom condo townhome in Vaughan also sold out over the weekend. And it's just to illustrate the point, at some point, there is going to be investor or end user demand that comes back. And one of the arguments that I will agree with CMHC is that when we get to a negative real interest rate environment again, which technically means risk on to a certain extent, the rationale that an investor end user starts to make is, well, it does make sense for me to get back into the market. And this is what I've always talked about. You don't read the headline to say, hey, the bottom is here. They don't put up their hand and say, hey, it's time to buy. You have to create your bottom. And at some point, the market will turn back because it's always cyclical. When that is, I don't know. Because you have in CMHC's report some things I agree with and some things I do not agree with. So it's very hard to strike that balance, which is why it's always very, very hard to put a crystal ball on and say, hey, I know what's going to happen in the next 1 or 2 years. Nobody does because there's so much uncertainty that's happening. You could argue for CMHC being correct that we may have some kind of inflation adjusted recovery by the end of 2027. Or you can look at the fact that we may have a massive recession and that prices aren't going to go up for a long time. Or you can also argue that negative real interest rates are upon us very soon and we could be on a risk-on environment where asset prices do go up. There's a lot of ways to actually think about this. And this is why I've always said, if you're trying to buy right now, go create your bottom. Go find which seller is desperate right now, because if things get better from a sentiment side, the sellers aren't going to drop their price as much as what they're willing to do right now when there's a lot of fear and there's a lot of inventory right now. And this is exactly what I talk about in this video, where there's a lot more distressed sellers than there have ever been in the last decade. And this is why it actually makes sense for you to create that bottom. If you want to understand that, make sure you check out the video that's on the screen, and I'll see you in that one. Until next time, your move, your future. See ya.